Hi, I'm Lee Stone and this is your UFXBank Week in Review. Today we will be covering some of the major financial events of the past week and how they impact the global currency markets. But before we cover headlines of the week, let's go over the last week's risers and fallers. The euro had a down week against the dollar, trading at 127.08 and losing nearly 1.5% on the week. The British pound traded mostly down this week versus the dollar, finishing down 0.7% to close at 153.53. The USD and Japanese yen traded mostly mixed. By the end of the week, the dollar had dropped 0.27% to close the week at 84.18, while the US Canadian dollar also traded mixed on the week, finishing down 0.38% and last trading at 103.54. Oil had a poor showing most of the week until Friday trading, when it surged nearly 3 points to finish the week up 2.5%. It last traded at 76.45 a barrel. Gold traded mostly down through the week, losing 0.28% to close at $1,245 per ounce. There were not a lot of major events in the currency markets this week, although we could say that the week was marked by a decline in haven currencies, which generally indicates optimism for the world economy. The Swiss franc fell against 14 of its 16 most commonly traded pairs, while the yen also showed signs of weakening towards the end of the week. Though this type of investor news is often associated with an increase in risk appetite, there remains some tension as it appears Europe's sovereign debt crisis may be creeping back into the news. For more on this, let's go to our analyst, Martin Smith. Martin, hello.
Hi, Lee.
So what can you tell us about the debt crisis?
Well, doesn't seem very likely to go away, does it? The euro dropped to a one-month low versus the dollar and fell against 15 out of 16 of its major traded counterparts. On September 7th, the Wall Street Journal reported the European stress test that happened 2 months ago had understated some sovereign debt holdings. So this has led some analysts to speculate that Greece faces a substantial default risk. And when the original program to help bail them out will expire, they may need to extend the original 110 billion euro loan they received from European banks. There's a strong likelihood that any news out of Europe will have significant effect on investor actions, especially any news that may heighten concerns of a faltering recovery. So I'd imagine that economists will be lowering forecasts for the coming months and that news out of the US will have significant effects on the value of the euro.
So what are analysts saying about the US economy?
Well, we received positive news the prior week, didn't we, regarding unemployment, when better than expected data came out from the non-farm payrolls. Still, the estimates for the second half of 2010 are below their original forecast, and unemployment is unlikely to fall below 9% in the foreseeable future. The other major economic indicators are also below original forecasts. Consumer spending, for example, has averaged a 3% increase per year over the last few decades, but fell 1.2% last year, which is the most significant decrease since World War II. Household purchases are another. These were slightly down against their forecast of 2.25%, and this showed that they will likely climb at only a 2% rate for the remainder of the year. The data is having a strong effect on employers, causing them to hold off on large purchases or new hires. So although many are waiting for sales to increase, I think they are also waiting for more clarity on factors related to the election, such as taxes, healthcare costs, and new financial regulations. So overall, I think a clear picture of the US economy's future will only hinge on US election outcomes, because economic policy could take a dramatic swing based on those results. I see estimates being more like guesstimates until we have a clearer sense of what direction policymakers will be steering the US economy.
Well, any positive news then, like positive indicators in the US economy?
Well, yields on the 10-year US Treasury note jumped to their highest levels in a month, which may be an indicator that risk aversion is declining. I'd also like to note something that I should have mentioned earlier, and that is many of these pessimistic forecasts are somewhat counter to the opinions of the Fed chairman, who believes that factors are in place for a strong economic pickup in the coming year. As I said before, although I think a clear picture will only come once the election results are final.
Well, I guess that's fair to say then. Okay, let's go now to our Ask the Broker segment. Juan Hernando Guzman of Seville, Spain writes, what do you see for the US dollar Swiss franc pair?
Well, if you look at the one-year chart for the US dollar, USD CHF pair, you can see that they had a significant rise leading into May of 2010. This was followed by a dramatic selling off, which saw the pair fall from 116 levels down to 101. Now, the interesting thing we have been seeing is that in the last week, the pair has been rising steadily. So this indicates that the pair could see a strong rebound, at least to a more balanced level. When using Fibonacci retracements, we can see that the pair looks poised for a strong upward movement. So based on the data I've looked at, I'd guess that in the coming months or so, we'll likely see the USD CHF reach 107. And I see it as a strong buy candidate.
Well, thank you very much, Martin. Well, we hope you enjoyed our weekly review, and we hope you will join us next week. Until next time, be sure to visit us at UFXBank.com for simple, safe, and secure trading. Also, you can follow us on Twitter and Facebook. To submit your own questions to our weekly broadcast, please email your questions to martinsmith@askthebroker@UFXBank.com. For UFX Bank, I'm Lee Stone. Good luck and happy trading.